All right, so most of us know the VIX, right? The market's fear index. But what if I told you there's a deeper, more powerful signal that most people just completely overlook? A signal that actually measures the volatility of volatility itself. Today, we're going to do a deep dive into the VVIX and uncover the market's hidden tensions.
So that really is the central question, isn't it? If the VIX tells us how much fear is in the market, what tells us how certain or, uncertain the market is about that level of fear? Well, the answer is this amazing second-order indicator that can give you a really critical edge.
Okay, so here's our game plan. First, we're going to unpack this whole fear of fear idea. Then, we'll get into decoding what the VVIX is telling us at different levels. Look at some advanced ways to combine it with the VIX, see why it's so incredibly important in today's market, and finally, show you how to use it as your own powerful signal.
To really get a handle on the VVIX, we've got to start with its more famous sibling, the VIX. They really work in tandem, but you have to understand that they measure fundamentally different layers of what the market is feeling.
Think of the VIX as our first layer of information. It's kind of like the earthquake we can all feel. When the VIX is high, the market is basically saying, hey, we're expecting some big price swings in the S&P 500. It's a direct measure of anticipated turbulence. Pretty straightforward, right?
Okay, but now we go deeper. This is the second layer. The VVIX measures the volatility of the VIX. So if the VIX is that earthquake shaking the ground, the VVIX, well, that's the pressure building up on the tectonic plates deep, deep below the surface. It tells us how fast the market's expectations about fear are changing. A high VVIX means traders are scrambling, trying to price in massive, sudden shifts in the VIX itself.
And this is really the key distinction you have to remember. The VIX is about expected movement in the market. The VVIX is about our certainty about that movement. It's literally measuring uncertainty about uncertainty. And that's precisely why it can act as such a powerful leading indicator, spotting trouble before the VIX even starts to move.
Okay, that's the theory. But how do we turn this into something we can actually use? Well, the level of the VVIX isn't just a random number. It's telling a story. Different levels are like different warning systems, everything from a quiet background hum to a full-blown crisis alarm.
So, you can basically break the VVIX down into these 4 zones. Just to give you some context, the historical average is sitting around 86. So, anything in that 75 to 100 range, that's just the normal hum of the market. Business as usual. But once we cross 100, you can tell traders are getting nervous, buying up protection. Now, the magic really starts to happen above 130. That's the siren, the warning that the current market trend is just running on fumes. And above 200, that's maximum panic, a level we've only seen in huge crises like back in March 2020.
But let's really zoom in on that 130 level. This is the magic number. This is the real action zone for traders. When the VVIX spikes up past 130, historical data shows a 70 to 80% chance that whatever the market is doing, whether it's trending up or down, is about to reverse course, usually within the next 2 to 4 weeks. It's just an incredibly powerful signal of market exhaustion.
Now, the VVIX is incredibly powerful on its own, for sure. But its true potential, that gets unlocked when you start looking at its relationship with the VIX. The interplay between these two can show you what the really sophisticated institutional players are doing behind the scenes. It's actually pretty simple. You just create a ratio, VVIX divided by VIX, and suddenly you have this really clear, normalized signal. A ratio below 5 suggests everyone is way too comfortable, a potential trap. Between 5 and 6, you can feel that tension is quietly building. Get above 6, risk is elevated. And once you're over 7, you are in a high-risk zone where violent moves become much more likely. It's just a super elegant way to get a single, unified gauge of market tension.
And this right here, this is probably the most powerful pattern of all. It's called divergence. This is what happens when the two indicators are telling you opposite stories. You've got a low VIX making the market surface look totally calm, but a high VVIX is screaming that there's chaos underneath. It is a massive red flag because it means that while everyday traders might be relaxed, the smart money is quietly buying up protection, preparing for a sudden shock. They're getting ready for a storm while the sun is still shining. It is the absolute classic complacency trap.
Okay, so all of this isn't just theory, right? Let's apply it to the market conditions described for late 2025, because it's a perfect case study of this hidden fragility we've been talking about.
So you might be asking, okay, why is the VIX so low then? Well, a huge piece of the puzzle is the absolute explosion of these zero data expiration options, or zero DTEs. I mean, look at this number, a staggering 61% of all S&P 500 options volume. Because dealers have to hedge these gigantic positions all day, it creates this pinning effect that artificially pushes down the VIX, making the market look way calmer than it actually is.
People have started calling this period the Great Thaw. And it feels a lot like the Great Calm back in 2017. But, and this is a huge but, there's a critical difference. 2017 stability was built on a really solid economic foundation. The calm of 2025, though, it's kind of engineered by these weird factors in the options market and by Fed policy. The foundation is just much, much weaker.
And this is where our tool becomes absolutely essential. So as of late December 2025, the VIX is just chilling at a very calm 1360. But when you do the math and look at the VVIX/VIX ratio, what do you see? It's hanging out between 6.1 and 6.6. Now remember those zones we talked about? Where does that put us? Right in the tension building zone. The VVIX is telling us exactly what the VIX is hiding. There is major stress just under the surface.
So at the end of the day, the real goal here is to turn all this insight into actual actionable strategy. The VVIX isn't just some academic thing to talk about, it provides real, concrete signals for managing risk and for making trades.
Let's break it down into 3 pretty straightforward strategies you can think about. First up, reversal trading. When that VVIX blows past the magic 130 level, it can be a really high probability signal to get positioned for a market reversal. Next, ratio trading. You can use the extremes of the ratio. A reading over 7 might be a good time to bet on volatility coming back down, while reading under 5 could be a cheap time to buy some protection. And finally, for just general risk management, when that ratio starts climbing above 6, it's a clear signal to think about reducing risk and maybe raising some cash.
There's a quote from the source material that just sums this all up perfectly. The Great Thaw may prove temporary, and the VVIX will likely signal the shift before the VIX does. It's a reminder that this calm we're seeing might just be an illusion, an engineered state that's a lot more fragile than it looks. And when it breaks, the VVIX is probably going to be our first warning.
So as you look at the markets from now on, I want you to ask yourself this question. The VIX might be telling you one story, a story of calm, a story of stability, but now you have a new lens, a new way to look deeper. What is the volatility of volatility? What is the VVIX telling you?